Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 30th of April. I'm Daniel Lam, your host for the podcast. Perhaps the biggest swing in macro narrative this year is the number of Fed rate cuts to be expected. At the start of 2024, investors were pricing in as many as 5 rate cuts for this year. Starting from March, this quickly eroded to 3 rate cuts, and now many are expecting at most 1 to 2 rate cuts for 2024, with some seeing risk of no cuts or even rate hike this year. The stickier than expected inflation figures in the US, as well as the strong growth numbers, are the main reasons behind this. So, are we at maximum hawkishness from the Fed? Probably not yet. So let's check some of the indicators. First of all, let's try to get some clues from the recent Fed talk. Looking at the recent policy comments made by FOMC officials over the last month or so, and assuming that most of them may take out a cut since the previous FOMC meeting due to the strength of the US data, the quote-unquote real-time median Fed dot plot for 2024 may imply 2 cuts for this year. But the options market is more hawkish than the Fed speak. If you look at the SOFR options, the implied probability of Fed policy remaining on hold this year has risen sharply over the past month. Now, SOFR, for those who do not know, is the Secured Overnight Financing Rate, which is a broad measure of the cost of borrowing cash overnight, collateralized by Treasury securities. Now, this analysis is implying Fed funds by year end at 5 to 5.25%, so i.e. between no cuts to 1 cut. In fact, SOFR December 2024 options are pricing a 30% chance of rates moving above the current 5.25 to 5.5% range for Fed policy, i.e. a potential rate hike. Now, understanding if we were at the peak of rates is quite important for those looking for income investment. For example, the US 10-year Treasury yield is on the uptrend and probably going to the 5% level. Taking the analysis above, it probably pays to be patient before looking to add to fixed income. In terms of equities though, as we spoke about in our podcast last Thursday, the influence of macro factors seems to be less nowadays compared to times such as 2022. The sectors and stocks, especially in the US, are moving in a much more idiosyncratic manner. That is all from me for today, and I would like to tell you that there will not be any cut to the chase tomorrow because it is the May Day Labour public holiday in both Hong Kong and Singapore. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.